Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how on where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Welcome, Freedom Fighters. In this week's special minisode, we conclude our look at what's in store in 2019. What does it mean, and what do you do about it? Now, last week we started with a macro-national approach, so this week we drill down to a more granular local level. With insights from highly regarded South Australia selling agent Scott McPharlin of Magain Real Estate. And I followed this up with some concluding comments on where I see things heading. Now, for those of you who don't know Scott, he's a proven performer and a multi-award winner with over a dozen years' experience in the industry, and his honesty and integrity and down-to-earth, no-nonsense approach is very refreshing. Now, Scott's got a record of selling properties at a great price 3 times faster than his competitors with a 93% success rate. Now, I've personally known Scott for many years, and I'm repeatedly impressed with his knowledge, his pragmatic, proactive approach, but most of all, his reliability in calling it how it is instead of telling you what you want to hear. So, to get the inside running on what will affect property on the national but also the local SA front, along with potential hot and not spots, please enjoy this very informative chat with Scott McPharlin. Freedom Fighters, we're here with Scott McPharlin, who's a leading agent with Magain's here in Adelaide. And being the start of a new year, it's always a good time to have a look at what's coming, what are the storm clouds, what are the opportunities, what are the risks, what are the things that we need to be thinking about, and what are the things we need to be doing. No better person to give us a really informed, hands-on view on all of that. Scott, welcome. Great to hear your thoughts.
Thanks, Bushy. Thanks for having me. It's certainly an interesting time in the market.
It is
very exciting.
Yeah. I mean, there's certainly a lot of gloom and doom in the media, and if you believe most of that, you wouldn't do anything. I've always had a contrary view, and that's get the real information for the people that know what's truly happening. What's your view of where things are heading from the property side over the next 12 months?
Yeah, well, I'm definitely not going to sugarcoat it. There's going to be some challenges coming in 2019 for sure.
Yeah.
That is mainly around getting money. I think most people are going to struggle if they're thinking it was as easy as it was 12 months ago to get a loan to buy a property, then they're going to be really surprised.
Yeah.
I think, coming in the next 6 to 12 months, anyone that isn't organised, that is highly leveraged, is really going to have some challenges getting hold of some money.
Yeah, it's a very good point. And there's been a recent in-depth research study done by UBS that has quantified that people's borrowing capacities as a result of changes to living expenses and a number of other measures will drop by between 20 and 40%. Yep. So that's a fairly sizable amount. So if someone bought a property 12 months ago and expects to go and do the same thing again, there's no question they're going to be in for a bit of a rude shock.
Absolutely.
So what should buyers be doing then in the coming months to make sure that they're clear on where they're heading?
So the first thing that I would say is buyers definitely have to be aware of their own situation. They have to have a really good agent on their side when it comes to talking about their own properties, and then they have to have a mortgage broker that is renowned and very good at what they do to make sure their finance side of things, they know exactly what their situation is.
Yeah.
I really think the people that are going to be able to take advantage of this market are the ones that get themselves in a position to buy as quickly as they can and then become very patient.
Yeah, it's a very good call. And I think the change that we see from the finance side, Scott, is that because of the extra rigour that's been applied to the processing of applications, timeframes are now much more elongated than what they used to be. So the old days of a 30-day start to finish are possible but rare these days. If someone's budgeting it, we often say to people, well, you need to allow at least 6 weeks in the current climate for two reasons. One, because the processing by the banks is slower, but two, quite often because the banks are in a very conservative outlook at the moment and some of the bank valuations are coming in tight and below, we need to have the option to take a particular purchase to another lender if we need to get the purchase across the line. Yep. So what are the other things that you're seeing that people need to start thinking about, mate?
Yeah, well, I guess, as far as, for me, the market is the market. You know, people are going to have to do things because of the time it is in their life, no matter what. They might be having a baby, need a bigger house, whatever the case may be. Yeah. So quite often, just because the market is not perfect for the transaction doesn't mean that they're not going to do it anyway. So for me, it's about making sure that people get themselves in a position to be able to take advantage of the best things about this market. Yeah. And the best things about this market is there's going to be more stock available.
Yep.
There's going to be less competition, which means that there's going to be the ability for people to be able to buy better properties at a better price and have more choice.
Yeah, that's a really good point you make, because rather than looking at it in isolation, most people who are selling a property are going to buy another property.
Correct.
And if we're in a zone at the moment because of the perception that's out there, which is not necessarily a reality, but if the perception is that things are a bit interesting, the good news is that the changeover cost between what you sell the existing one for and what you buy the next one for is likely to be less now than what it's ever likely to be.
Absolutely. If we always talk about people that are buying a bigger family home. So you're selling one, and yes, it might be a little bit harder to sell and you might not quite get the same price that you did, but you're buying the next one for less, and therefore you're putting yourself in a position when the market does increase and you get some more capital gain, that you're getting more capital gain on the more expensive house.
Yeah, exactly.
So you're actually going to be better off. You're probably going to be in a better suburb. You've got a better home. Yeah. You've got a way better situation where you're going to be able to take advantage of market conditions.
Yeah, no, very good call. And I think the preparedness is the thing that you've mentioned already, that just to reinforce that, mate, there's a couple of things that we're seeing from the financing side that potential purchasers really need to have a good look at. And that is not only of this borrowing capacity being squeezed, but conduct is going to be absolutely key. So where the banks traditionally have just used an average guess on what your expenses are, as of the last few weeks, they're now asking to look at your last 6 months' actual transactions on what you've been spending. So what it means is if you're about to buy a property, then make sure that you are very conservative in your spend in the 6 months leading up to it, but also make sure your conduct is absolutely squeaky clean. So no 1 day late paying your credit card or a couple of days late paying your home loan. Those days are gone. If you're not absolutely squeaky with that repayment history, you're gone.
And so what about the 3 times a week Uber Eats?
Absolutely. Any of those sorts of things, holidays, Netflix. A big spend at Christmas time, you've gone out and eaten well, and you've bought big presents for the wife and the kids. Yep. The banks are going to say, well, that's not one-off. That's we're averaging out your expenditure, and because it's so high, we're only going to let you borrow this. So really controlling the funds now is going to be paramount to how much you can borrow and whether they'll let you borrow. So
absolutely.
Yeah.
So I think spending habits is definitely one of the things that people are going to get a real shock at, because I think there's a lot of pretty loose spending habits when it comes to what people put on a credit card.
Yeah.
And the unfortunate thing with that is it's very trackable. The banks can see exactly what you've done, whether it's been a sports bet withdrawal or a couple of times home in an Uber a week, and then that all averages out over the month, and therefore they've got a real picture as to what you actually spend.
Yeah.
And now that is what they're going to take in determining whether you can pay back that loan. And that is going to restrict not only whether you're going to be able to get a loan, but if you then are able to get a loan, how much you can borrow.
Spot on. You summed that up beautifully. And just to put some colour around that, we've had a recent example where one of our brokers presented an application to a bank. The particular borrower has had some medical issues and had an operation. So there was 2 months where there were quite high medical expenses, and they're not going to occur again. It's a once-off, but that's not the bank's view. The bank's view as well, we're going to use those actual medical expenses to average out what your ongoing cost position is. Yep. And as a result of that, sorry, you can't borrow the amount of money you need to buy this property.
Absolutely. And once again, it's a very conservative way of viewing it as far as the banks go, but they can't afford to go through what they've just gone through with the Royal Commission and that level of, I've just lost the word, but, that level of interrogation or, scrutiny again for the same things. So, they're almost going to get away with it this time.
Yeah.
Because, realistically, the government didn't act that quickly. Having known that the situation was going on for a long time, they're not going to get away with it again. So then they're going to be ultra conservative this time.
The good news though, if we look at on the positive front, the restriction on interest only lending, the APRA, which is the regulatory body that looks after the banks, have now lifted their caps on the amount of interest only lending that the banks are able to muster. So we're likely to start to see a bit of a release in that. So that will ease off, and that'll make it a bit easier for investors potentially. So that's good news from the demand front. And I also think that once the final report for the Royal Commission is tabled, market forces are going to start creating a situation where the banks have, their loan values have dropped quite substantially. Yep. They all answer to shareholders.
Correct.
They're going to need to start increasing the access to funds to boost their own profits. Yep. Later in the year, we're likely to see things start to swing back towards a better position. So, from the property side, though, what are the other influences that you're seeing that both good and bad that are likely to present themselves this year?
The other thing that's going to be a very big challenge by the looks of it this year is the fact that we're more than likely going to be into a federal election as well.
Yeah.
And so I'm very cautious about the timing as to, yes, the Royal Commission report is going to be tabled. That might be February. It's going to take a couple of months for the banks to sort out what they want. Yeah. Then all of a sudden, if we're into an election period, these things are going to overlap, which is really, it's going to make 2019 a little bit challenging.
Yeah, the first half of it, I think, will be. I think the election's got to be by May. So we'll have a result one way or the other by the end of the May. And let's face it, with the way the media is caning the Liberal Party at the moment, I wouldn't be surprised if Scott Morrison takes it right up to the end of the May before he calls it. But once we've got through that and that uncertainty is out of the way, if we see the banks start to relax a little bit and there's a bit more certainty then around what's happening in the exercise, then it's actually a good time to be doing something.
Yeah, absolutely. I still believe that this market is a great time for anyone looking to transact. You've got to have some really skilled players on your team that know how to navigate the circumstances. And if, obviously that's the sort of business we're in, but if they have taken care of that side, then this will be a really rewarding time.
Let's dig into that a bit, because I think you've hit on a really good point. For anyone who is selling a property this year, the selection of the agent is going to be absolutely critical to that.
Absolutely.
Talk to us a little bit about what are the key things that sellers need to be looking at in their agent to make sure that their interests are being optimised.
Okay, I think, and just having a look at the campaigns that have been successful, not obviously really focusing on my own stuff, but I think consistently people that in this market have experience and have seen this market before, so have probably been in the industry around that at least 8 to 10 years, who have seen these sort of market conditions, that know how to react, that are hard workers and up to date with their knowledge and what it takes to find the best buyers using modern marketing techniques in this day and age are the ones that are really going to get you a result that's mind-blowing.
Yeah, and I think also I'd be focusing on agents who, given the length of time they've been in the market, have access to buyers that are looking for opportunities that the average punter who's just relying on advert and real estate comms not going to even know about.
Yeah, I feel to get the best price for your property, you can't just put it on a property website like realestate.com or Domain and hope the buyers find it.
Yeah.
Ultimately, I always say that we're looking for the best buyer, not just any buyer.
Yeah.
And, I like to work out, okay, so if you've got a property that's worth $400,000 in Morpeth Vale, then, what you get for your money at $400,000 in Morpeth Vale is a lot different to what you get for $400,000 in Shido Park or Hallett Cove or Aberfoyle Park.
Yeah, yeah.
So, and quite often, buyers compromise for one of two reasons. They compromise on area because they need a particular house, a particular size, a particular style.
Yep.
So therefore location isn't that important because the house is important.
Yep.
Or they compromise on house size because they need to be in a particular location.
Yep.
When we're looking to sell a property, we're trying to find a buyer that's willing to compromise on location.
Yep.
Because they'll normally bring a bigger budget if they're looking in a more expensive suburb.
Yep.
So how do we attract one of those buyers that it was traditionally looking in Hallett Cove, Shido, Aberfoyle Park to actually come to Morpeth Vale or Christie's with their budget and pay more than what the average local would for that house. And that is the art. And because if we can show that they are better off in value about coming and buying this house, then quite often they think it's cheap.
Yeah.
And therefore the purse strings get let up and they'll pay more.
Yeah, good call. Good call. Coming back to the election, let's say the federal Labor government does manage to get in, and they then implement their changes to negative gearing, where they'll effectively abolish negative gearing for existing properties, and they'll reduce the capital gains tax discount from 50% down to 25%. Not likely to actually get legislated for a year or a year and a half yet, because it'll take that long to go through the process if they indeed are silly enough to implement it and force potentially the recession that we didn't have to have on good old Australia. But what's your view then of if the Labor Party does happen to win the election, is that going to have any extra impact on the property market itself as you see it?
I think if we could stop it happening, then that would be a good thing to do. But, ultimately I don't like to get too political.
No.
But, I think it would be dangerous, and I think a lot of the independent research houses are kind of thinking that will be dangerous as well. There's going to be, somewhere in excess of 600 billion wiped off the price of the Australian property market, and I think everyday Australians are going to suffer because of that.
Yeah.
I think what it's going to achieve is all it will do will reset the market at a lower level, and it will still have the same challenges.
Yeah, that's a good call. That's a cool. I've been saying of recent that a vote for Labor will be a vote to take 10% off the value of your house potentially. Yep. And if you're happy to do that, that's fine. Yep. But you're right. Once the market is reset, it'll be pretty much business as usual as far as
we'll have the same challenges, the same problems.
Yeah.
And it's just, ultimately, people have got to understand that negative gearing and the capital gains discount was done to make sure that there was enough housing stock so everyone had somewhere to live.
Yeah.
Whether that be rental properties or somewhere to own.
Yeah.
Now, with the immigration and that sort of thing that's happening, I believe that we still haven't got enough housing in Australia, despite the baby boomers getting to that point where there's still going to be some of that housing coming available. Yeah, there's still not enough.
No, absolutely right. Just
supply and
to
demand.
Put a little bit more colour around that as well. Not only do we have an existing substantial housing shortage across the country, we're talking, I think it's about 500,000 houses short at the last count. This is nationally. We've still got ongoing immigration pressure, but the things that aren't factored into people's thinking is that the average household size. So we've gone from an average household of 4 down to about 2.5. Now, just by doing that, you've effectively put a 40% pressure on housing stock numbers. Yep. So without the, regardless of what happens to population, we've still got some considerable demand pressure just by the fact that, unfortunately, due to divorce and other things, it's putting pressure on. And then if you add the fact that people are living 10 to 15 years longer than what they were, yep. Then those three combined are going to continue to put very significant pressure on supply.
Not only that, I think also the other side of the thing is a lot of the housing stock in Australia is your standard 110, 120, 130 square metre, 70s built, that probably isn't that perfect style of housing that everyone actually wants these days.
Yeah.
So I think there is a transition in the type of housing, and so the new modern stuff that everyone actually wants, there's not enough of that stock.
Yeah.
So I think there's definitely going to be a big changeover towards, almost updating. It's like we do for roads or infrastructure or anything like that. I think our housing is going through a cycle where it is getting updated as well.
No, good call. That's a very good call. So if we talk locationally then in and around, and we're talking South Australia in particular, are there particular locations that you're seeing both within your specialised patch but perhaps broader within the metro area that you think offer opportunities over the next 12 months?
I think there's definitely going to be a lot of focus towards Port Adelaide.
Yep.
Obviously with the jobs growth out there, I think there's already, you can already see the start of price growth in and around that area, and that's people speculatively buying stuff, which is the same thing we saw down south here when the railway got announced and the expressway got announced, is probably the capital growth that did happen as a result of that actually happened before the infrastructure even hit the ground. It was pretty much the announcement that came, everyone jumped in and bought, the capital growth was happening there, and then when the infrastructure followed later, there was no actual capital growth.
Yeah, good call. No, it's good call.
So I see that sort of factor probably happening in
Port
around
Adelaide.
Port Adelaide, Birkenhead, that sort of area. In the very short term. Do I think it's going to be enough to make me buy there for 10, 15, 20% of growth? I don't think so, because I think that will get saturated, and the focus there will be a very quick short term. I think other areas where more traditional transport routes, shopping precincts, all that sort of stuff.
Good school catchment zones.
Good school catchment zones are going to be even more imperative. Because I think a lot of that workforce is probably going to be local, and they already know and love Adelaide and are going to be living more in their local area and prepared to travel. Because 40 or 50 or 60 minutes is actually not that bad when you look at other states.
So does that mean that that's the tightly held areas close to the city and close to the beach? I mean, the beach strip is always a
beach strip is
must-do.
obviously always prime. Down south, we've got some of the best beaches that you ever find in Australia at some of the cheapest prices. And when you have a look at the price, the median price for Christie's Beach or Port Lunga or Seaford or Port Lunga South or Moana, I noticed that Mark Williams has just put his property up on the market in Moana, so that's a really interesting property to come to market. Congratulations to the boys down at Southgate that have put that up. So, and then the other one that's really interesting for me is not so much beach, but it's beachside, and that's O'Sullivan's Beach. It's definitely going through a massive regeneration at the moment. There's a lot of development stuff going on down there. It's got great access to the dog beach, which is really popular amongst South Australians as well.
Good call.
So from that aspect, it's the lowest beachside medium-priced suburb in Adelaide. And so I think if you can start at the bottom, the only place that can go up.
I agree, and it's actually, given it's been closer to the industrial plant there at Lonsdale, it's probably a bit overshadowed and forgotten about, but given its proximity to everything, it is prime, given its low cost base.
The bits I really like about O'Sullivan's Beach, and it probably has got a bit of a reputation as well, but obviously the refinery is gone now, and that used to be right next door. So now that eyesore is pretty much gone. And one day, that land will be developed into something, whether that's commercial or residential. There's probably a few things with contamination, that sort of stuff that's got to be sorted out. But one day there's going to be a big piece of focus there. Now, if you're taking a 20 or 30 year view on your investment strategy, then having something there, I think would be pretty sensible.
Very sensible. Very sensible. I think there's some really good opportunities there. Awesome, mate. Well, look, to bring this all to a head then, to summarise the takeaways for those that are looking at what's happening over the next 12 months, what would you say in conclusion?
First thing, I think it is a great time to consider your options. I think if the opportunities in the market are going to be able to buy properties at better prices and have more choice.
Yeah.
And so therefore it's a great time to assess your options.
Yeah.
And yes, if you had an appraisal 12 or 24 months ago, it might be a bit less than what you were told then, but that doesn't limit what you're actually able to do.
Yeah.
Just because your house value might be a little bit less than what it was, or the market might be a little bit tougher than what it was, doesn't mean that what you're going to achieve is going to be any harder. It's actually probably going to be more financially beneficial for you right now.
Yeah, for the changeover. And I guess that the thing that I didn't say, to give people confidence that are listening, the interest rate environment is likely to be very stable. Yeah. In fact, given what's happening with the cost of money and what's happening overseas, the next RBA move is probably likely to be down, not up. Yeah. But in saying that, it's probably likely to be offset by the banks who may actually increase off-market their rates to cover their additional cost of funding. So the end result of that will be a nil-all draw, and the rate market is likely to be very flat.
I think it's just such a great time to try and get yourself organised and get yourself into that new home so that you're ready to capitalise on the market conditions that will happen in the next 5 to 10. Yeah. It's going to be an exciting period for South Australia. It's lots of new industry, lots of new jobs, and it's kind of the rebuilding of the industrial side and our jobs market. And I think with where we live and the proximity to beaches and wineries, and it's going to be incredible. Oh,
it's the best kept secret in the country, mate. It's the quieter achiever. I've been saying that we've become the Scott Bradbury of the real estate market. The ice skater who ended up winning the gold medal because everyone else fell over towards the finish line. That's exactly where Adelaide's at. All of the independent research that you mentioned is projecting us being either the number one, or at worst case the third rated growth state in the country over the next foreseeable few years. And if you look at, you've talked about Port Adelaide and the defence side. We've also got the space agency win, which will start to ramp up progressively over the next 10 years or so. The resources sector is actually on the rise. We're doing a lot of work with people who live and work in Roxby, and they're not making big noises about it, but there's a lot of positive stuff happening on that front.
Just recently, BHP had bought a hole that found more copper in one hole than ever found in any other mine strike. And, they're not going to shout too much about that because they want to keep that under wraps until they can have some sort of big announcement about it. But that's pretty exciting, just in our backyard. Yeah. The other side of things to that is, I think that, I've lost it. It's all good. I'm excited.
Yeah, I guess the thing that I want people to take home from our discussion today is, and I've been saying this for a long time, Scott, stop listening to the bad news, because it is all bad news. Stop taking on board the fear that the mainstream media want to continue to portray, because it creates controversy and sells newspapers. But the fundamentals of the market are still exactly the same. If you're into property, only get your information from people who are in it and are good at it, and then make true decisions based on what the actual reality of the situation is. So from where I sit, I'm as bullish about 2019 as I've been in any other year. There's always an opportunities in real estate if you're smart about how you do it. So really appreciate your time today, mate, and looking forward to getting you back on a regular basis to update us on how that's all looking.
No problems, mate. It was great to be here, and we'll talk to you again soon.
Thanks, mate.
Thanks.
Well, there's some more great insights there from Scott. Now, to conclude the last 2 weeks' special episodes on the year ahead, I'd like to share with you some of my own insights. And I need to stress that my comments are based on hard facts, and they're taken from respected independent forward-projecting research houses, not just my gut feel. And let me share with you some of those areas that I do tend to dig into so that I can join the dots to come up with more informed decisions. Firstly, I love to have a good look at Riskwise Property Research. They're one of the very few research houses that have detailed algorithms that project into the future of what's going to happen with housing. Secondly, I always tap into the quarterly Heron Todd White property clock reports that give an indication on where particular areas are in the cycle. Thirdly, I keep a close eye on Terry Ryder's Price Predictor Index, and I always have a good read of QBE's Australian Housing Outlook, along with BIS Oxford Economics 3-year housing projections. Now, if I look at those and compare that to the hysteria that I'm seeing in the main media around gloom and doom with property, I start to get a very different picture. And as an example, the 5 out of the 8 major areas around the country have actually experienced growth over the last 12 months and are projected to continue to do so, with the top 3 areas being South East Queensland, Adelaide, as well as regional areas including Victoria. And if I was a real contrarian looking at a long-term path, I'd be starting to look seriously at Perth. Now, putting some numbers around that, we're seeing the top 3 projected to enjoy growth of between 9 and 12% over the next 3 years. So despite the gloom and doom that you might be hearing and reading, and I'd stop listening to the mainstream media because it'll stop you doing anything, the fundamentals are all continuing to be very strong. But I do want to dig into a little bit on what will affect property values moving forward. And the areas that I tend to look at, if we look at the global situation, I always have a close look at what's happening between China and the United States, because the Australian economy still relies quite heavily on what's happening in China. So Trump's efforts in trade negotiations there are going to be quite key. And the read there is that given the cost of money internationally and with the interest rates increasing globally, it's likely that the Reserve Bank will keep local Australian interest rates steady. And in fact, we may even see an RBA drop to offset any bank off-market increases in the cost of their loans. So overall impact will be that there's probably likely to be very little, if any, change to interest rates. So quite steady, and money will continue to be cheap. However, there are a number of other market drivers that we need to take into account. Now, the most obvious one is the federal election, which must occur before May. And of major note there is to really take on board the Labor government's proposed changes to negative gearing and capital gains tax, which will have a major impact on everyone's home values if they're instituted, and I'll talk more about that in a minute. Secondly, the Royal Commission on Banking will continue to tighten access to credit. So we're seeing some ongoing changes there, just make it very difficult to get hands on money. And thirdly, something that hasn't been spoken much of yet but will start to get some airplay is that open banking is being phased in from July 2019. Now, this means that, in simple terms, open data will be accessible to anyone, and it means that the major banks initially, being Commonwealth, ANZ, the NAB and Westpac, will make data available on credit and debit cards, deposit and transaction accounts. So it'll be imperative to make sure that you keep your conduct of any of your savings and loan accounts absolutely squeaky clean. Now, the impacts of these put together will obviously mean that borrowing capacities will continue to be down in the short term. And there's actually been quite an in-depth study done by UBS Investment Bank Research, which confirms that borrowing capacities across the board, not just for investors but for everyone, are down by 20 to 40%, which will pretty much have a direct flow on to purchase price capacity. So a major one there to take on board. But secondly, the uncertainty generally means that people sit on their hands short term, particularly in the lead up to an election. And for me, who tends to be contrarian, this is a great time to secure property if you can get the money, particularly over the next 6 months when everyone else is going to be wanting to be sitting on their hands and listening to all the bad news in the newspapers and on the TV. Now, I've said this a number of times, but as a big believer in Buffett, his quote is quite appropriate at the moment, and that is that be fearful when people are greedy and greedy when people are fearful. So in the current climate where there's a lot of fear floating around, if you're in a position to take advantage of it, great time to be securing property. Now, I've always said that property is a game of finance, and access to credit will determine demand in the short term, and it's become almost self-fulfilling where the media, the government and the banks have all tightened credit, and no great surprise, that's meant that property values have dropped in particularly Sydney and Melbourne, and that will continue in the short to medium term as a hangover from the ongoing Royal Commission. And the key things that are going to impact on everyone in relation to borrowing money for either a home or investment property will be particularly living expenses. Now, traditionally, living expenses have been based on averages or a benchmark that's applied. Now the banks are using your actual living expenses. So you need to be very careful about that, because they're going to look at what your expenditure has actually been in the last 6 months and use that to determine your capacity. And the actual living expenses are generally much higher than the previous historic benchmarks. But in addition to that, the banks are now looking much more closely at what's called the loan-to-income ratio, or LTI for the jargon. And what that simply means is that regardless of how much the bank service calculators will tell you can borrow, if the loan is any more than between 6 to 8 times your earned salary or earned income, and that excludes any investment income, by the way, then that's as much as you're going to be able to get your hands on. Thirdly, there's also going to be increased pressure from the banks to buffer credit card limits. And what that means in simple terms is that you really need to reduce your credit card limits if possible, because it's going to have a higher impact on how much you can borrow. But on the good news front, APRA has taken the pressure off in relation to the caps that were put around interest-only loans. So interest-only loans are now likely to be easier to get than what they have been, which will be great news for investors taking advantage of that. So that's a good overview of the major drivers. So let's now have a look at what does this all mean to you and what should you do about it? Well, in simple general terms, I think this year's a year of quiet consolidation. And for me, I'd be looking very seriously at refinancing any of your existing home or property loans, because you've got a massive opportunity to reduce your repayment costs. Now, just as an example, it's not difficult. Our finance architects and brokers here are averaging savings of between $400 to $1,200 a month off our loan repayments, which in simple terms equates to giving yourself a free pay rise of between $7,000 to $24,000 a year. So quite significant. And the other thing I'd be thinking about is if I'm an existing investor where I've got a number of properties in addition to a home, is to make sure that your bank hasn't cross-securitized your loans. Now, what that simply means is that most banks do this without even saying too much about it, but it generally means that if you've got several properties and several loans across those properties with one bank, it's fairly likely you're going to be cross-securitized. And that comes with some pretty big risks. One, it means that all loans are secured against all properties, so if something goes belly up, the bank can come and take the keys to the home. But it also restricts your flexibility and also reduces your borrowing capacity if that's the case. So one of the things I'll be doing if I'm refinancing would be to make sure you move to a standalone loan structure where each property and each loan is independent of the others. So you then have the flexibility and control to do things with properties without worrying about the others. So look at refinancing and look at removing cross-securitisation and moving to standalone loans. So now let's break it down and have a look at what that means to homeowners, to sellers, to buyers and investors. Already talked about homeowners, refinance and get rid of cross-securitisation. That's the easy maths there. If you're a home seller, if you have to sell a property this year, then your choice of selling agent is going to be absolutely critical. So the things I'll be looking for in a good real estate agent, as opposed to the average, is make sure that they can prove to you they've got a great network of actual pre-qualified buyers, and that's buyers with strong incomes with good equity, because, as we know, getting bank loans is going to be more difficult. Secondly, I'd make sure that they've got great negotiating skills and get them to prove that. And thirdly, make sure they've got very strong market awareness. Now, if I'm looking to buy a home this year, then the things I'd be looking very carefully at are making sure that my credit conduct was absolutely crystal clean. So no late repayments, no over-limit activity on any of your statements. I'd be very carefully controlling living expenses, particularly over the last 6 months. As I've said, if you're in a position where you've had a big Christmas and you've spent up big on the kids and you've gone away for a holiday, then that's going to impinge on how much the banks will let you borrow when they look at your actual expenses. And thirdly, I'd be making sure that I get a pre-approval from a good finance broker before I went looking at property. So I'm absolutely clear on how much I can borrow, but more importantly, how much I can actually afford to buy a property for, because the days of buying a property and then just going to the bank, they're well and truly gone, as many people are finding out. Now, if I'm an investor this year, you just need to know your achievable numbers. So 3 things to do. Connect with an independent property investment advisor that's a member of the Property Investment Professionals of Australia, or PIPA. They've got a great website and all of their PIPA members are listed there. They're all independent professionals, so you're making sure that you're getting advice in your interest, not someone else's. Secondly, I'd make sure that I get a finance pre-approval via a good finance broker prior to doing any property searching, so that you know exactly what your achievable property purchase price is. And thirdly, given what's happening with the banks and what may happen at the federal election, I'd be joining the Property Investment Council of Australia, or PICA, which is a group that's looking to independently protect the interests of the 2.2 mil in mum and dad property investors around the country, and to advocate on their behalf to banks, the government and the community at large on the economic benefits that property investment brings to us all. So in conclusion, I always adopt a very long-term view, so I'm not overly concerned about short-term moves, and I say this backed up by what I've detailed in my book, The Freedom Formula. So if you haven't had a chance to read that, grab yourself a copy, because it tends to put the current scaremongering in context, and I'm pretty relaxed about that as a consequence of the fact that I'm adopting a 15 to 20 year view, which I suggest you do the same. So looking at the medium term, it is going to be strong, nothing too much to worry about there. Certainly in the next 6 to 9 months, money's going to be very tight, but that means there's going to be plenty of opportunity if you're looking to secure property. And lastly, I just wouldn't be voting Labor unless you're happy to wipe somewhere between 50 to 100 grand off the value of your home. So I hope that's been useful. I hope that assists you in making some good informed decisions this year. And next week we'll return to our normal format. So enjoy your week, get invested, and we'll talk to you then. Bye for now.